it's a rich topic. It's a rich topic because right now we have an energy crisis, and the environmental movement, the ESG concept, has vilified, particularly by this administration, fossil fuels, and it's becoming quite problematic. And the war in the Ukraine has made it far more problematic in that Russia cleverly and insidiously has used natural gas as a lever with the hope to ruin the EU, and we have all sorts of problems. But what I've done is I've reviewed with Nick and Elissa, and I'm going to make quick intros, and we're going to have a 10-minute segment, and then for each of the presumably 4 people, and then come back and have question and answer, because there is a lot to cover here. So Elissa is out of Goldman Sachs, the vice president in sustainable solutions. She has a BS in applied economics and management and environmental resource and economic strategy from Cornell. She's a CFA with an ESG investing grace note. Could you tell us, Elissa, in your opinion, as I struggle through here, what ESG and impact investing means today, where you see sustainable investing, the sustainable investing space evolving, and then touch on key environmental themes and technologies you are attracting, and lastly, the key social themes. And what I'm going to do is I'm going to stop you at 10 minutes. These are subjects we've discussed, so presumably you're ready to rock and roll. So go ahead, Elissa.
Okay. All right, definitely cut me off if I get over 10 minutes. I talk about this all day, but it's really great to be here. So thank you for having me. Again, I sit on the private wealth management sustainable solutions group at Goldman Sachs. So that means day in and day out, I'm working with individuals, families, endowments, and other small institutions focused on ESG and impact investing in their portfolio, more broadly, sustainable investing. I think
What's your family name again?
Elissa Cook, COO. But I think what's valuable in this discussion is start with kind of defining ESG or sustainable investing more broadly. If you Google the definition, you're going to see incorporating environmental, social, and governance factors alongside typical financial and operational diligence. But for our clients, we think it's really important to take that a level deeper and think about ESG as being different tools for different parts of a multi-asset class portfolio. So kind of in Goldman speak, we have acronyms and terms for everything. When we think about sustainable investing, we divide it into kind of 3 main categories. You've got alignment strategies, integration strategies, and impact investing. And so if you very simplistically think about a multi-asset class portfolio, alignment and integration are going to be tools used in public markets. And when we say impact investing, that's purview of private markets. And so I think where some of the headlines have focused is very much on alignment strategies. By that meaning strategies that are either doing negative screening, divesting from certain sectors, or frankly, positively tilting, now that ESG data is a little bit better, into companies while maintaining benchmark-like exposure. So this is typically passive public equity and fixed income strategies. Where you take it a step further is with integration strategies. So that's saying, let's use environmental and social factors to either manage risk in an investment strategy or find opportunities for alpha. So if alignment strategies are trying to be the benchmark, integration strategies are trying to beat the benchmark. And then when we think about, the quote unquote impacts of these alignment and integration strategies, I think that's a huge part of my job is to, temper clients' expectations there. When you're doing an alignment strategy, when you're in an ESG ETF that is, SPYX, S&P 500 X fossil fuels, you are divesting. You are taking, your voice and your shareholder proxy voting abilities off of the table. And really, it's more of an act of free speech, if anything. When you move towards an integration strategy, that's when you're actually leaning in to additional themes, having the opportunity for outperformance alongside making that impact. And really, frankly, where it's most tangible is in that last bucket. So impact investing being private market investing, private credit, real estate, equity, that's investing in either social enterprises or companies in new technologies that are effectively having measurable, that's kind of the key word to the definition, environmental and social impact alongside that financial return. So that's the kind of framework that we're working in. There's a lot of definitions to go through because there is a ton of nuance, and frankly, ESG means something different to every single client. But in terms of, I would say, moving to Tyson, your part of the question around where it's evolving and what does ESG 2.0 look like, I would say a lot of the recent conversations with regards to alignment strategies have been focusing on kind of the divestment dilemma. And instead of perhaps building strategies that are kind of blankly cutting out energy, oil and gas, certain utilities that are over, invested in coal in their generation mix, thinking more about engagement and active ownership of companies. So that's a huge theme that we're seeing and something that we think is going to be really critical. We've had a lot of client inbounds on the back of the Russia-Ukraine crisis. So we've had many clients come to us to say, I think weapons manufacturers and defense contractors actually provide a social good. They are providing the opportunity to protect sovereign nations. I think energy companies, especially in oil and gas, are critical for energy security. And the thing is that there isn't a data point at GS that can say that we will not need to continue to invest in fossil fuels, and fossil fuel consumption will continue to go up over the next 2-3 decades. So we're having more conversations about how do you find a manager that is going to be actively engaging in the portfolio companies to push them in the right direction in terms of climate and emissions disclosures, making sure that they are investing in new technologies as well as traditional, upstream and downstream technologies. So that I think is a huge part of the evolution of this space right now. And I would also say that there's a growing interest and a growing part of the ESG market that's focused on more thematic funds. So instead of just being a broad general ESG fund or a general kind of trying to do it all and tackle all environmental and social issues, we're trying to direct clients that have specific passion areas into more thematic funds. So a clean energy infrastructure fund, or a fund that's fully focused on fintech and education technologies. And we think, especially for our clients, we want to make sure that they are getting the returns that they're looking for if it still aligns with their investment objectives, but perhaps introducing some of these more satellite allocations to thematic funds. And I think the market is responding to that as well. And then I would say the second piece of evolution that we're tracking in this space is with regards to ESG data, so corporate disclosure. I think there's a lot of movement in Europe from EU and UK regulators to help push this forward. It's obviously coming from the SEC with 2 proposals out in the last couple months. But I think what's really important in this space is to use the data in the right way, to avoid looking at ESG scores and look at more quantitative underlying metrics like carbon intensity, and be able to visualize and show those things to clients as they're making ESG decisions.
Is that corporate data going to be only for public companies or for private companies?
Yeah, so right now the SEC is obviously focused on public companies, but we think that any regulation that they put forward is going to have a profound impact on private companies because they're such a big part of the supply chain of public companies. So that means that when they're trying to calculate what's called scope 3 emissions or supply chain emissions, we've got scope 1, scope 2, and scope 3, direct, indirect, and supply chain emissions, that these public companies are going to have to put pressure on private companies to do standardized reporting as well. So right now that's more of just like private market coalitions, asset management coalitions trying to standardize public market or private market reporting. But we think once SEC rules pass, there'll be a lot more pressure.
Is that domestic or global practice?
So right now, the only kind of laws out are for the EU. So the European Commission has what's called a Sustainable Finance Disclosure Regulation, SFDR. There's also MiFID II regulations that impact the disclosure of ESG funds. And these kind of more pressure on the financial services are trickling down to corporates. So if you're a global corporation, you're going to have to be compliant.
Right. So I'm asking if the reporting is going to be, if I'm a global corporation, is it going to be for my US practices or for my global practices?
Right now, there isn't going to be a global standardized reporting. That would be the kind of Panica solution, but you're probably going to have to, in your different financial statements and reports, report in a different manner for US versus European regulators. But I think the last point I'll make to kind of close out that piece on data is, say we have many clients come to us and say, I care about climate change, I want to combat climate change. And we're like, okay, great. We have a strategy for you, multiple strategies for you that are focused specifically thematically on clean energy. When we put it in their portfolio and we run some analytics, you actually see the carbon intensity, so the financed emissions in their portfolio, go up. And it's being able to walk through that conversation of saying, the players in the clean energy space are going to be traditional utilities. They're going to be heavy transmission and distribution infrastructure companies. And those companies by default have higher emissions. So being able to have that conversation.
Why are they in the ESG portfolio?
Why are they in the ESG portfolio?
To begin with, yes.
So I mean that's a value judgment of the individual investor to focus on ESG, but in terms of focusing specifically on clean energy, those are the asset owners and those are the individual, corporations that are going to have to contribute to an energy transition and be able to respond, frankly, to more renewables coming on the grid.
When we look at the ESG, is it an absolute exclusion that follow in terms of it, or is it a relative exclusion?
It's definitely not an absolute exclusion by any means. I wish there was a regulation or a standard that we could point to, but I think that's part of the complexity, and that's part of why we have to be nuanced in the definition of ESG, is that right now there isn't one definition of what's quote unquote an ESG fund.
GM is making electric vehicles off of that.
And is there any data on how ESG portfolio has performed relative to non-ESG? Because I haven't seen it. And strangely enough, this morning, the moderator of this panel suggested sectors that we should invest in, since we're heading to a reflationary environment, metals. These are all non-ESG, mining, energy, agriculture. They're typically not your ESG favored sectors as being going to be outperform the.
I think I would rephrase that as they're perhaps not the environmentalists' favorite sectors. I wouldn't say that is an ESG favorite sector. I think a lot of research that Goldman has actually done, there's a research piece that we can share, and actually, I don't know, we'll bring up the slides, but we've done a lot of research in what's called green CapEx investment. So to meet the UN Sustainable Development Goals for net zero water and infrastructure, we need an incremental 2.8 trillion, totaling 6 trillion over the next, for every year in the 2020s to meet those goals. And where that investment is happening is in metals and mining, utility infrastructure, grid infrastructure, agricultural practices, just because those sectors have higher carbon emissions and may not look as friendly or have been flagged for ecological controversies in the past, doesn't mean that they aren't essential to getting towards a future in which we're meeting these goals. We're able to respond to the fluctuation of energy coming on the grid from renewables. It's very much, in our perspective, an opportunity to take a step back and think about ESG holistically as a huge capital expenditure and investment opportunity across some of those industries as well.
Thank you. That's 10 minutes. Perfectly timed.
All right. Nailed it.
I just don't want more questions. The questions should come after, and we have another great speaker, and his name is Nicholas Rohleder. He is a co-founder of Commodities. He's on a steering committee for Climate Commodities, does supply chain finance, physical trading, insurance, metals. He's interesting because he comes from a oil family, and then has worked and is an adjunct professor at Columbia at the climate school. And I have a couple of questions. Nick also has a master's in environmental studies with a concentration in environmental engineering and technology from the University of Pennsylvania, where Marty and Donald Trump went.
Elon Musk.
Okay, so Nick, you are third generation oil gas family, and you are now focused on the climate and clean energy space. How has your background shaped your view of ESG? And I have another question. I'll give you a couple, and I'll give you 10 minutes too, and then we'll go to more questions. What do you see as near-term opportunities in ESG? What are you focused on? And what should carbon-intensive companies and energy families, what can they learn from what you have learned about ESG. So go ahead, 10 minutes.
So there's a lot there. One, thank you for having me. And two, I mean, just a little of my background. I'm originally from Tulsa, Oklahoma. Grew up in an energy family that operated a series of businesses along the value chain, ranging from physical trading to midstream and storage. And really, I think, I learned the business in the field, bare bones, working manual labor jobs as a kid, and I ended up going to school for alternative energy technology and environmental engineering, and made my way into the alternative energy space and building a business there, which I've been doing for the last 5 or 6 years. So it's really interesting when we think about ESG and the opportunity set here. It's really more from a business operator perspective, and how do you think about taking a mega trend like ESG and building a real operating business around it. So I think just from our perspective, being in the commodity business for the last 50, 60 years, where I look at it and looking at what I learned growing up is the biggest opportunity is in taking this materials gap that we see that has to occur for any of these ESG goals to be fulfilled and trying to monetize it. So from our perspective, you take base commodity business and you look at anything we use today, everything on this table, our cell phones, that everything that goes into that, if you index that to throw out the bank projection, and you index it to, let's say, population growth over the next 30 to 40 years, and you add a supplementary variable and say, how many of those people in the developing world are driving cars, eating meat, and consuming like we do in the West, we run out of just about everything. So I think from our perspective on the commodity side, looking at the real picks and shovels of climate change, the climate economy, ESG, however you want to characterize it, there are going to be generational opportunities in materials substitutions that enable us to stay in life and transition. So that's really, I think, from my background on the family side, how we think about how do you take, they built the business around really the build out of energy infrastructure in the United States. Like, how do you build a business around the reimagination of energy infrastructure and just general consumption patterns globally? And I think that's at a base level how we think. What we're seeing in the immediate term, a couple of trends. We're in the process of building out a captive insurance business to absorb technology performance risk. If you look at the core, what we see in our space, right? If you think about what's needed to go to a vanilla fixed income investor, an infrastructure investor, and enable them to invest in climate technology to the tune of $6 trillion per year, there's a lot of capital out there. But what there is not is there's a capital gap on the material side, and there's a service gap on take it, for example, a hydrogen facility that overlaps our space, right? Takes in natural gas and it spits out hydrogen. So in that process, if you're going to talk to someone and say it's a fixed income investment, there needs to be an insurance wrap on that technology, and there needs to be very sophisticated contracting on the other side of the facility. There's a lot of capital to build that, but there's not a lot of services and ecosystem partners to, let's say, ensure that performance risk, and then come on the other side and contract on either end of the facility so it looks like it's de-risked. So I think from our perspective, we started with an operating business on the alternative energy side that focused on contracting. And then we've gone into the insurance side, and we're now building out a hedge fund product that focuses on what we call critical materials and mineral space, really ranging from hardware down to minerals. And so I think that there's a lot of things in our space, talk about to Tyson's point, what's the opportunity set now. You look at these mismatches that you can monetize in the near term, and how you really look at, think about, for example, like on the public equity side, or just in general, the ecosystem approach where I teach students at school is, you take an electric car, right? You strip that into the 100 pieces it's in. Where is there long-term sustainable margin protection in that car, right? At a base level, everyone in here, you get in a car, right? Care about two things generally: the experience inside the cabin and the fuel economy. That really, if you're looking at how you can play that, think about microcontrollers, right? That's enabling a lot of that, right? And you can't go as a GM and say, hey, Mr. Microcontroller, you're going to cut your price, right? So, and there's certain areas of this, what we call materials ecosystem. There's sustainable growth and there's long-term margin protection. So heading into an inflationary environment, rising interest rate environment like we are now, there are certain aspects that are tied to this megatrend of decarbonization that have real growth and real margin protection over the long term. So we try to take that base idea and apply it to as many things as possible in this area. At a base level, that's how we think and how we've started to monetize things in this space. I think, to one of Tyson's other points, just looking at where ESG is going to go, obviously we're specifically focused on the E and really more on the technology side. And I think that from our perspective, the way we look at it is that if you look at how the operating business was built, you have to be within a niche, but a generalist in that niche. And then the ESG side, some of the things that we do, we really need to take engineering talent and teach them finance, because the critical risks that we're going to incur are engineering risks, not financial risks. And so it's interesting if you look at way we think about this space evolving, we try to be within a niche of we call the climate economy, but native across that market, because the available return, think about that space, right? It's specific. So the available return in the climate economy is going to change drastically year over year. The last 3 years, we've had zero interest, well, last 2 years, COVID in there too. We've had zero interest rate environment. There's been a ton of interest in the space, and the US has ushered in positive climate policy for the first time. So you see a system where that available return at that period of time, we'll see we're running risk, that's a long only book, right? 3-4 years ago, which most people were not running risk in this space. Tariffs come on when Donald Trump was in office. That's a major stress event to that space. And the available return goes to perhaps in the public markets, looking at small cap issuers and saying, okay, on a 4-year period of time, do you need a convertible piece of debt? Can we structure a hybrid instrument that helps you get to that scale, make that impact, but makes us money? And every year that's going to change, right? And I think that it's really important to look at being a specialist within this climate economy area, but it'll be native across those markets and really focused on that engineering talent piece. Because as you step out the risk spectrum and really reach down the risk curve, you incur more and more technical risk. And that's the critical failure point of some of these businesses. And we started to see that today. If you look at, take municipal solid waste to, there's a lot of focus in this area on the circular economy, which manifests itself in many different things. But there's also in this space in general, and that specific vertical, a ton of fallen angels. There's a lot of distressed product. There's a lot of things that have been done that probably shouldn't have been done. And but the risks were analyzed from a financial perspective, not an engineering perspective, and that's where it failed. So I think that we think about the continuum of how this space is going to develop. We really look at, if you think that most people in this room probably agree that we're not going to meet a lot of these targets we've set out in the near term with this Russia and Ukraine situation. I think it's a fair assumption to say. So to get the exponential impact to meet some of these targets, you have to take drastically more technology risk. And I think that we're very acutely aware of how that's going to develop from a risk perspective and also from a developing human capital in our business and adapting to respond and monetize what is going to occur. And I think the last thing, I know I probably one time, Tyson, I apologize, but the last thing is, we went through a really interesting experience just as a family business, looking at what the opportunity set is in alternative energy. And one thing we realized very quickly is that if you look at something like the space is two things. There's electrons, there's molecules. Electrons are very mature, and the service ecosystem is available now in public markets, private markets. The molecule side, take hydrogen, for example, it's developing and it's very interesting and it's going to get there, but that's really a pure play, private equity, venture capital. It's a different risk profile technology-wise, and the business model is adapting and evolving. So if you look at a hydrocarbons intensive business like ours, our core staff, process engineers, chemical guys, they're not set up to participate. Most people know in engineering school, like a petroleum engineering guy usually is horrible in electrical engineering. So if the whole business is electrical engineering, it's pretty hard to say we're going to plant a flag there and compete. So it's interesting if you look at some of these legacy businesses. We worked with a family in Oklahoma as an advisor that set up legacy midstream business focused on effectively cryogenics, natural gas, the natural gas treating ecosystem, and used the core competency to build a hydrogen business, hydrogen equipment business. And they realized without even thinking about it that a lot of that legacy talent can be repurposed overnight to be impactful in this climate space. So I think that one thing we're really looking at for especially legacy businesses still operated by families is what most of them treat too is people in this room. Family business, somebody's been working for you for 20 years. It's become part of the family pretty fast. And a big thing is how do you keep these people? Right? Like, what do you do? And I think that there's really interesting opportunities to allow people and enable people that are going to get displaced from the oil and gas sector. Then also, just in general, have been displaced, let's say, in the Rust Belt, traditional manufacturing, to holistically participate in the build out of this climate ecosystem. Right? And like that to me is like, you look at it from an operating company perspective, it's very impactful. And like at this present moment, you think about the continuum from electrons to molecules and how this space is going to develop. there's near-term monetization opportunities of real businesses, margin protection, generating cash now, and there's generational opportunities that evolve and adapt from the reimagination of the global energy and consumption system.
So can you give a couple of examples of that?
10 minutes.
Tyson, you
Go
mind
ahead,
if I
give some
just,
examples. And I got a quick question. Is Kyle there? Is Kyle sitting in the window space?
is Kyle here? No, Kyle is not here.
One of our speakers who's big time was supposed to be here. I was speaking with her earlier. Go ahead, Nick, answer Marty's question, please.
A couple of examples of these ready for prime time businesses.
So today, for example, like we're involved with the business EnergyLink, right? There are about 100 heads, fully integrated solar plus storage engineering services firm, right? In that situation, the motor on that business is built really in the electrical engineering talent and the ability to retain that and lend it out as a service. As the focal point becomes, you can build a solar facility tomorrow. That's a mature space, right? When you're thinking about you putting up alternative investment returns, right? Let's say like, if you're running a hedge fund, right? Like you really, if you can't put up 15% net, you shouldn't be running a hedge fund, right? So you look at like the opportunity there to put up big returns. You're looking for a business like that is addressing something like, let's say, for example, solar space, the exact thing here. There's huge amounts of money coming from institutions that have repurposed fixed income desks to buy things like this, right? 20-year paper or just 20-year investments in this space, so you get 4%, 5%. Looks like a fixed income proxy, but there's actually a lot of technical risk within it. And some of these vendors, like let's say, for example, panel vendor 10 years ago on a 20-year contract, they might not be around. Space has changed dramatically. So we look at it as that if we have an engineering service business that's going to come in and say, you have a busted system, we can come in and provide a service to that. And maybe if we're backed by a fund, we could buy that and turn that around with that contract that was hit above levels today. And at a base level, that being the upside case, the base level is that you're tied to a huge megatrend, you have a reasonable margin business, and you're addressing a problem, right? So to your point, the next iteration that's mature, that's ready today, people are investing in energy storage to backstop the intermittency of solar facilities and that integration, right? Like if you have a solar facility, there's a lot of people out there that say, look, like I have a business, energy storage service, you show up to somebody who owns a solar field, a wind farm, I'm gonna put storage right there. The technical process that you actually implement to integrate those systems, there's a motor on that and there's margin protection. So that's something that's happening today that over the next 6 years, that investment in that mature area of electrification is going to scale dramatically.
Why do you say there's margin protection? Is that because the government's involved, or I don't understand. Where does the margin protection come from?
The people. Like if you look at it right now, like there's very few businesses in the solar space on the service side that can attract and retain phenomenal engineering talent. And that is overlooked, right? Until very recently, these businesses were operated like commodities, right?
So you want petroleum engineers to become solar engineers?
Well, you can't. So I made you need to separate electrons and molecules, right? The whole thing there is that we look at some of the opportunities as finding businesses that they're totally separate businesses, and that's why you look at what's mature now and what's hindered the oil and gas industry is that the oil and gas industry's core talent is not positioned properly from a skill set perspective to participate in the mature portion of the energy transition technology ecosystem, which is solar, which is storage, right? So their opportunity set is saying, okay, so how do we take our existing system, our free cash flow from our production, our midstream, and what part of the ecosystem you're in, and how do we create like what we would call internally a climate smart capital allocation program and start thinking about what do we do to decarbonize our own systems, and then to go to other producers, other companies, and offer that as a service.
Do we have any measure on that transitional cost?
On which side?
In general, of decarbonizing.
So, I mean, a lot
of people are going to lose their jobs. I'll give a great example. This is the story of Connecticut, right? So Connecticut used to be a major military arms builder back in the 70s. Jimmy Carter came in, everything to solar. They cut back on military spending. Military spending never came back to Connecticut, right? United Technologies is headquartered there. They own Pratt & Whitney, right? And a lot of that building just stopped. And so all those guys lost their jobs in the 80s. Jobs moved to Japan, China, et cetera. And all those guys who were PhDs and engineers became casino dealers at Foxwoods casinos and I forget the name of the other one, Mohegan Sun, right? So they were all, I mean, you had like, PhDs, master's degrees in statistics becoming dealers at casinos. because they lost their high-paying head of household jobs.
But this is different in the sense, what you're doing is sort of engineers for hire to modernize companies' infrastructure as they move forward in whatever policy they want
migratory, yeah.
in solar.
Well, that's one thing we're involved with, right? And that's like a mature now business.
So they're selling their skill sets in time. Is that their business?
That's any contracting business, exactly. What
They're
they're doing.
almost like
So they have
consultants.
no carry in the business that they modernize or.
So this is another. So
They never would have stock options like engineers in business.
the other thing too that's interesting is that if you look at this, if you flip the script, like my primary partner Ben used to be a portfolio manager at Millennium, and then was with the early team when Castellan took over Louis Dreyfus Energy. If you look at thinking about how to take a legacy business, take a contracting business, right? And you flip the comp structure and you think about like a multi-manager hedge fund, right? And you get people to say, okay, so wait a second, you have a busted solar facility and you need our service. And what if we take some warrants in your development company, right? So like, most people who run these legacy businesses, and I think on the family side, it's been our core competency is to think a lot differently, right? If you think in an institutional construct and you apply it to some of these sleepy businesses, there's a lot of opportunity there.
I get it.
Tyson?
Yes, I want to say that Luis Medina has been dealing with a medical emergency, and that is why he has not been in touch. I'm still trying to reach Kyle. Marty, do you have a follow-up question, or are there any questions from the audience? And then I'd like to go back to Elissa.
Again, I'm looking for that, the economic gap. Like, a great example is this SEC reporting. So everybody talks about decarbonization, but if these large companies like, Pepsi Cola and McDonald's, et cetera, start having to report their carbon pollution, Pepsi Cola is the largest plastic, bottle pollution in the Pacific Ocean, right? That would be pretty negative for them on the SEC report, wouldn't it?
The comment that I would make there in terms of the SEC reporting regulations. So the first one came out was saying you need to report your carbon emissions, scope 1 and 2 and 3 for the largest companies, less reporting requirements for smaller companies. The second regulation is an adoption of the names rule. So making sure that ESG funds are labeled accordingly and disclosing their investment objectives and policies accordingly. So for the carbon emissions reporting rule, I think we're actually probably not going to see a meaningful step change in what Fortune 500 companies are reporting, because they're already doing it. Even through a administration that was less ESG friendly, consumer pressures and all of the regulation that was happening in Europe have already encouraged these large companies to report scope 1 and 2 emissions, and they've done some of the legwork. What's going to be difficult for these companies is the cadence of reporting that the SEC will be mandating. So they have been calculating and collecting emissions. Now they're going to have to put them into their 10Q and 10K reports, which is on a different timeline. So I think there will be stress in terms of getting the reports out on a regulatory determined timeline, but in terms of the actual numbers, that's been in the works for the last 5-10 years for many of these companies.
So I guess the nuance I'm trying to note is that, so Coca-Cola is the largest domestic producer of beverage in the country, and it's highly compliant with the rules of the United States, right? They produce 80% of the soda, it all gets recycled, their cans, et cetera. Pepsi is not anywhere close to it, but it's a global beverage seller, and it's compliant with each country it's in, which are polluters, right? They sell in China, they sell in India, and all that stuff goes into the ocean, right? They're not recycling any of it. So, so the nuance is that all of a sudden they have to start reporting how much they pollute to the general public, which they really don't report right now.
Yeah, so it's
right?
really
Even though they're compliant with law in each country they operate in.
Yeah, so I would distinguish it's carbon emissions reporting versus plastic pollution. So the regulation is around carbon emissions. So what is the emissions equivalent of the electricity that they're paying for and taking off of the grid to run their factories? And what is the pollution?
So it's not environmental
air
reporting,
pollution.
it's just carbon.
Correct.
So to piggyback on that, I think it's important too to look at some of the opportunity set is you're looking at two things, right? In the immediate term, like there is an opportunity and it's very fragmented, and I'm not much less well positioned to speak about this, but on the reporting side, there are going to be businesses that pop up that package reporting and are kind of compliance in a box. It's simply ETF in a box. Well, I think we're at the early days of that. that's not necessarily the exact focus of our business, but if you look at the opportunity set to go, some of these big companies, what they're going to start doing is taking their reporting infrastructure and lending it out to other businesses for a fee. And I think that is standalone business, right? Because you look at what, like, take for example, like a big a module we always do in the course I teach. You look at Taiwan Semiconductor and strip through one of their sustainability reports, for example. They go into exceptional detail from water use to waste to energy use to process innovations as to how, you know, this is a fully zero waste, net zero fabrication process. So like a small company can't do that. And there's a business there in lending out that know-how. Just right now, the problem is, I'm curious your thoughts on this. There's no centralized infrastructure to understand what needs to be reported. And if the SEC ratchets up how fast you have to do this, that's going to really put pressure on mid-sized businesses.
Definitely. And I would say who's doing it now, it's some of the biggest market data providers. So MSCI, Morningstar, Sustainalytics, Bloomberg, Thomson Reuters, they're already engaged in that space because we're paying them a lot of money for this data at the moment. So there is infrastructure in place as these regulations tick up to get that data. I think it's just a matter of what will be the required metric that deters like which reporter aggregator kind of wins.
So Tyson, I had just a question more from the different sectors, because as Elissa said, this the ESG component can be interpreted so widely or differently by many. But particularly, we were discussing the nuclear power. Many of us growing up, nuclear power can be a scary thing, but if you could mention that briefly, then you were talking about the envisioning things in the future. I used to work at Commodities for 10 years. So if you look at the electrical grid in and of itself, to me, it's a very inefficient system that in time will get more efficient. Right now, 50% of the power coming into New York is really generated from hydropower, assuming it's going to be available in the future from Canada and so on. So it seems to me the source and the demand side are going to have to come much closer, whether you do it by generating power with the windows or battery technology as it gets better in each much smaller place. Things like that are interesting for me from a macro standpoint. So I don't know, start with the nuclear side. If I could.
Can I just add on to Peter? So we actually had some engineers talking in California about this 5 years ago, and they were talking about the inadequacy of the network to be able to take solar energy being fed back into a centralized point and being dispersed again, right? It's not, it's really a dispersal from the centralized energy dispersion and not collect energy from other locations.
You're
Which is
talking
why
about
they
energy wastage on transmission, right?
that too, but they stopped giving, like, that's why they stopped giving solar licenses in Hawaii, right? They reached 10% and the grid couldn't take it any longer. So there's a need to redo the grid, so.
Just the way I'm playing it is investing in superconductor technology, which will allow for superconductors to operate at near to room temperature. And there are material scientists working on this. I've invested in that. That would save 20 or 30% of energy that is being lost on transmission to heat, which is a big. If you could save 30% by you have a big whatever source that you want, solar, wind, nuclear, whatever, you have to feed it to the cities. And you have to put these things far away. You're going to lose a lot of energy. So the transmission aspect is key, and would reduce energy wastage tremendously, which would solve a lot of problems.
Yeah, and I think to put a number on that, in terms of the 6 trillion to meet net zero goals that we're looking at, transmission and distribution infrastructure, the investment needs to be around 525 billion per year. It's a really significant investment area. And in terms of the other kind of perhaps non ESG thought of technologies that we're looking at, specific to nuclear, as part of that 6 trillion, and this was even before these estimates were calculated, before the Russia-Ukraine crisis, it's about 90 billion that needs to be put into nuclear generation. At this very moment, there's about, I think it's like 55, 60 nuclear reactors across the globe being built, and that momentum is going to have to continue in order to meet these net zero goals.
So the nuclear power plant being built in Georgia right now is 4 times over budget, right, in the first phase. So I'm wondering, is there any energy estimate of cost that's ever correct?
Yeah, the global plan,
Yeah.
Marty, Kyle Fox just joined us. There was a miscommunication about the time. And I just wanted to quickly introduce her because she can talk about some of these large scale opportunities. And Kyle's led $75 billion worth of debt and equity, and she's the global head of capital markets at HIG. She's an international banker. And Kyle, we spoke earlier today. Can you talk about some of the projects that you're working on as it relates to now current and tangible projects in the ESG space?
Yeah, thank you very much. So some of the things that we're working on include, we're building from scratch a plant to produce clean methanol in Mexico. It's situated at the border basically of Mexico and the US. And basically currently Mexico is a net importer of methanol, and we're building a plant estimated around $1 billion to develop and producing over 700 kilotons of methanol. And the benefit of methanol essentially is twofold. One, it's being used and the ships are being refitted, so it can be used as fuel for shipping containers. So that's a big sort of dirty energy user of fuel, and it's a great way to make a strong impact in the environment. And then secondly, as hydrogen is used more and more across the board in order to reduce carbon impact on a whole host of uses, from transport to shipping and also heavy industrial, methanol is required in order to transport hydrogen, and therefore will support the transition to use of hydrogen. So those are two very impactful ways that methanol production, clean methanol production, can have a very strong and positive impact. And as you know, the time goes through, as technology continues to increase, that type of migration from fossil fuels to hydrogen will be very impactful on the environment. The other thing
right there, because I think that transition to hydrogen would be beneficial to the audience here if you could talk about it. My understanding is that there needs to be some progress in bringing the cost down to make it economically viable, but that's good potentially within 3 to 5 years. Could you elaborate on that?
Yeah, I mean, essentially a lot of these technologies, including being 100% green methanol production, you know, it takes a lot of scale in order to make it economically viable for the plants and also to be competitive as an alternate fuel source. So hydrogen is the same, and also there needs to be sort of, basically the way like methanol as it relates to hydrogen, the reason why it's so impactful is that you can use the existing infrastructure to transport hydrogen using methanol, so that it also mitigates some of the capex that you might need to have for methanol to kind of retrofit it to so I'm just looking at a question to retrofit, you know, just for hydrogen, because this is unstable gas essentially. But yes, look, a lot of these things between the cost of production or the cost of like transporting and using it, it will all come down as scale increases and technology increases. But it's definitely within a 3 to 7 year horizon that we'll see significant change, and that will just exponentially increase efficiency over the next 10 to 15 years.
Will that include other technologies like LNG?
There was a question here.
Yeah.
How do you make the methanol?
Yeah, well, I'm not the engineer. I'm more on the finance side, so that's probably not the best question for me.
What's the primary source?
In terms of feedstock, or?
Yes.
Yeah, the feedstock is natural gas.
I
heard an interesting story where in Texas they're using the excess gas on top of rigs to power, you know, creation of alternative fuels as well as crypto.
That's it.
That's the sparking. That's sparking the natural gas. So that can be a clean energy source to do for the miners of Bitcoin or other cryptos. But you know, it has to be very particular, because not every time you flare gas, it can be successfully used for energy. So it's not always like 100%. It has to have the right dynamics, essentially.
Could I,
We
could
were-
I ask another question, Kyle? And that is, you mentioned not only do we want to clean up the environment by reducing, in the energy silo, but you mentioned also products that are manufactured in real estate as ways of reducing carbon and cleaning up the economy, and real estate development that you're involved that is ESG friendly. Can you address that, please?
Yes, thank you. So we're doing development from land all the way through to sale or rent. And what we do is we create self-sustaining residential properties, and also we combine it with light industrial, and we layer in solar and we layer in waste to energy. And then on top of it, we use different PropTech products in order to make us as efficient as possible in terms of energy uses, and also monitoring the properties. And then one of the examples I gave you from a building material point of view is a company that we invested in that basically is the coagulator for cement. And historically, coal was required to create this coagulator. And this product is actually part of the Bill Gates Breakaway Fund. They've created a synthetic coagulator that is 30% lower than the coal coagulator. So it's a B2B product for mass production of cement. So there's a lot of different initiatives across the board, from building materials to energy efficiency and tracking of maintenance of the building that can be used to be as efficient as possible with the resources that we have. And they're also quite nice, too, which is helpful.
Kyle, did you mean 30% less coal being used, or what was the efficiency? 30% what?
Oh no, the 30% was actually lower margin, so it's actually more cost effective than the coagulator. So not only is it environmentally friendly, it's actually cheaper.
Got it. Tyson.
Okay, I'm glad it looked like both Nicholas and Elissa had questions, but I want to go to Elissa because as an investor, I'm concerned about the potential market impact of the proposed SEC regulations that Gary Gensler has put forward. I've heard it argued by accountants saying this thing would be enormously problematic and costly. And I guess some of it is still being developed, but what is your or Goldman's opinion as to its impact on the market and the energy market right now and going forward?
Yeah, so just to clarify, you're referring to the carbon emissions reporting or the ESG fund disclosure regulation? Or both?
Both.
Both? Okay. So in terms of our view as an investor and also as a fiduciary for our clients, we actually think in this space, having some structure from the SEC around what is defined as a ESG fund and the disclosures and kind of the levels of green that you can get to is a good thing for the marketplace. We've seen some really interesting reactions in the marketplace in Europe as kind of an example. So basically in Europe, you can have 3 classifications of funds: Article 6, 8, and 9. And what we've seen is, unfortunately, many of the fund managers just get their funds to the bare minimum standards for Article 8, which is that middle bucket of green. So I think what's really important, and hopefully what's coming through in some of the proposed questions to the proposal of the SEC, is taking the learnings from what's happening in Europe to make sure that there's clear distinction in the levels of sustainability, or at least the investment objectives that the managers are pursuing for US investors. So we're actually glad that we're kind of falling in line after Europe from this perspective, and don't see, frankly, anything in the data or the fund flows that's indicating that the investment in ESG or green CapEx and inclusive growth themes is flowing anytime soon. I think what's a good stat that I can share is even in the month of May, in light of obviously all of the volatility and the Russia-Ukraine crisis ongoing, is of the muted but still positive equity inflows that we saw in the month of May, about 3/4, 72% were into ESG funds. So there's no lack of investor appetite, and these funds still have really great fundamental growth opportunities that I don't think the SEC regulations can really slow down, just perhaps help us put some more labels on what's in those funds.
Nick, would you care to chime in?
I think that, from our, it is very well said. And to add to that, it's interesting. I mean, I spoke on one of the main panels at Commodity Trading with Americas a few weeks ago. And I think the one thing that's overlooked is that a lot of people talk about carbon credits that's going to develop. That is a huge area of regulatory scrutiny that's coming down the pipe. I think just after what we just discussed, I mean, that's an area where you have an ecosystem. There's a couple funds that do it. Like take the California market, for example, the regulatory maximum is 200 million. So there's not a ton of scale you can get there. You can go into other niche markets and build fund products. The other side of this is there's not a sophisticated ledger in a lot of cases for carbon credits. That's another problem. And then the other issue is that there's not a regulatory infrastructure required for brokers or market makers, so to say. So you have this discontinuous market structure that there's a lot of participants that think about like fixed income when Bloomberg introduced Trace, right? Like that, these things haven't happened yet. And the ICC, the parties that be, there's a number of organizations are looking at this. You have groups saying, like, for example, Pepsi, Coca-Cola, they're buying carbon credits, right? And in a lot of cases, they might be getting ripped off. And there's not regulatory infrastructure let's say, encase that and package it and say you can participate in this market to meet your goals on a transparent basis.
There's a carbon credit coin.
Yeah, we're not in that space. There's pretty heated discussion at the end of that cryptocurrency. So I probably will not register an opinion on that.
Could any of the could Kyle, Elissa, or Nicholas address the idea that we could have nuclear coming online, I guess, in smaller scale? There's the next generation, and what the viability and opportunity is there. Anyone feel compelled to speak? Kyle, Nicholas, or Elissa?
Yeah, I mean, I can kick off very high level in terms of the 90 billion investment in nuclear that we need to meet net zero goals for our projections. That is going to be coming from new full-scale plants, extension of useful life of the current fleet of nuclear, and then also some more exciting technology, so like small modular reactors. But I would say that is a piece of the pie, and that isn't going to be driving, the bulk of electrons going on the grid.
Are you talking just about the US here?
Globally, it's global.
So what proportion would be the kind of the US process versus the European process?
That I don't have figures on, but can definitely follow up if we have more research there.
Because ultimately, I think the European process is preferable, except for for security issues. I mean, terrorism and all that sort of thing. Because it devolves down to non-nuclear ash, basically.
You're talking about like daisy chaining, micro nukes.
Yeah. So you use that process, you get ash, but you have intermediates that could be weaponized, right? Whereas the US process, your residue is not nuclear, not weaponizable, except for its radioactivity, and that's why we have to bury it.
Sure.
So it's not as efficient and the use of the uranium all the way down to ash.
Right. So that was a Jimmy Carter.
process.
That was a Jimmy Carter policy issue, right?
Yeah.
Where
I'd
he
like-
thought that this weaponization.
I'd
Listen,
like
can you
Kyle Fox to jump in here. You just posted a note, but if you could comment here on nuclear.
Yeah, I mean, look, I'm a big fan of nuclear, and obviously, but I have to say I'm not really an expert or doing sort of immediate work with it. But obviously, I think it's a very important source of energy to be developed, both in the U.S. and and in Europe as well, to sort of counteract the dependency on natural gas and other oil from Russia and other counterparties. So I think becoming more energy independent is very much linked up with the nuclear. And I think there's been a lot of progress in developing these smaller nuclear plants as well. But I think there's a long way to go, but it's definitely an important development. And I think that a lot of people were wrongly turned off from nuclear over the years, and which has kind of gotten us into a bit of trouble today.
I have a question for Elissa, real quick.
Oh, I think
Go
that's a
ahead,
question
Nicholas.
in the room.
Go ahead.
Oh, wait, hold on. What
Yeah, Tyson, maybe the same question. Listen, I had a long conversation with Nick earlier, and I'm sorry that Luis, my partner, is not on because he's all things nuclear. But does Goldman have any opinion on the current supply imbalance in uranium?
We do, yes.
Okay.
We are bullish on uranium. I think especially in light, that was kind of the tipping point for our research analysts relative to tracking uranium as a commodity. Most of the uranium is enriched in Russia that feeds the fleets that are in, Linya area. So very much seeing upward price pressure. What's difficult about addressing this for our clients is there's very few vehicles in the market to access uranium. So there's like one ETF, frankly, out there. But in terms of a tactical tilt and finding, tactical opportunities for our private wealth management clients, we are, trying to get them access to that.
Great.
Nick, it looks like you had a comment.
Well, I was gonna say, there's a couple issues, like, that's a really good point, perhaps. Like, if you look at the other issue, one, like the Russia is a significant counterparty, the source of uranium right now, and the US imports over 90% of uranium. So, like, from a full supply chain security perspective, we have a big issue. And then the other issue to that too, and we wrote something on this in the solar space around international trade law. But there's a lot of products in the supply, these clean energy supply chains, let's call them, that there's a state subsidy regime that backs something that's going to the international export market. And this is true in the uranium space to a relatively significant degree. And the issue is that a lot of the single name equities that you could play that through, either they're too small, they're pure play mining play, serial micro cap, which everyone who's been in small cap space understands that issue. And then, the real issue is that manipulates the cost curve synthetically. So like Chemico, for example, they get pushed down and they get into a situation where they can't operate profitably and holistically develop new mines, retrofit existing mines. And there's all kinds of issues that emanate from that. The other side of this too is, like, you look at the SMR space. One of the partners in our business ran this company, was part of this company, Ultra Capital. That was one of the sustainable infrastructure tiger cubs. They did a lot of stuff in the small modular reactor space. It's really interesting. If you look at, like, New York, for example, started the history of New York. There was a like I don't know what the exact street was, but like 1885 generating station in the middle of the city, right there. So like the idea, yeah, it's like probably on the wall of Con Ed, like the history of the city. And but the idea of reverse innovation that built places like in the developing world, right? That's coming back in a decentralized format. And I think on the nuclear side, it's really interesting. There's a discussion around small modular reactors to feed these decentralized systems. Whereas, like, that's one thing, but the real impactful side of this, how do we get ex-Russia uranium and build a nuclear system that has a base load that has a cost curve that's manageable for the populace?
Ukraine to invade Russia.
So we could do the defense stocks, right?
It's a classic supply. It's a classic supply and demand imbalance, long term, and with a
We have another
solution.
question?
Yeah. So
I was just gonna make a point. My name's Ardour. I'm a good friend of Pete's for 35 years, and my team interacts with Elissa at Goldman, sort of working with our high net worth families and institutions. I was a ESG hater, I would say, 7 or 8 years ago, saying that I didn't think my clients really care about it. They're focused on returns. About 5 years ago, 2 things sort of hit. One was one of my clients, CFO of a big not-for-profit down in Texas, said to me, his kids go to shopping every weekend or whatever, and they've got an app or two where they're looking to see where they're buying and what's sort of the rating of that particular company. So I said, all right, as a 50-year-old, I feel very disconnected to the 20-year-old space, but they're making those decisions. Talk about Coke and Pepsi. Those decisions are being made, and that's sort of driving a lot of those corporate decisions. And the other thing was institutional investors. They were fine giving up a couple of basis points or maybe some incremental volatility, tracking error, et cetera, to make sure they were checking that ESG box. And I'm seeing that certainly a lot of talk from a family standpoint, very little implementation, more on the impact from the private equity side, but on the institutional front, for us to come to say, you know what, this is what ESG overlay on our fixed income portfolio looks like. This is the change. And they're seeing a tangible grid saying, okay, this is the impact on carbon, this is the impact on women or minorities in the businesses that we're doing, et cetera. Very easy, no incremental fee increase, all that, and they are just flipping the switch left and right, especially on the low-hanging fruit in the portfolio. So those 2 things sort of are leading a lot of the conversations, because what these investment committees and institutions don't want to do is face a question and saying, are you doing anything from their constituents? And them saying no.
And just to summarize that,
I have a last question. That's for you, Elissa. One's a sort of a curveball, but it's very relevant. Just last week or 2 weeks ago, Germany said that they're going to start burning coal due to shortages of energy. And actually, Medina, who was supposed to be here but had a medical emergency, was very positive on uranium, pointed to a uranium ETF that you can buy. But he also was saying there is now a social component to burning coal because of the war, because you want to stop the war machine in Russia. And to me, it's like I had a client said, this is just Wall Street bullshit sort of thing. Now, I'd like you to talk about how Goldman or professionals such as yourself look at burning coal to deal with that, but also then kind of touch the one area we have not discussed, and that is DEI within ESG and why that's important.
Yeah, so I guess what I can share on that point in terms of Wall Street's position on coal, including Goldman, can't really speak for them all, but where the majority of Wall Street has drawn the line is not investing in net zero coal. That doesn't mean that they're not supporting continued coal generation. And I think that there is a kind of buzzword, but this just climate transition is very much a part of this
But
conversation.
clean coal technology is improving all the time.
Correct. Yeah.
And if it gets to a level where the emissions are very small, it could fit very well into an ESG portfolio. Why not?
Yeah, I mean, and again, the beauty is in the eye of the beholder for those when it looks at the energy industry. I think projection-wise, coal will continue to have to be burned, especially in light of Russia and Ukraine. I think it's the fact that we have to have that conversation pragmatically with clients is really where my expertise lies. You have to show them the data, you have to show them the energy demand, you have to understand the fact that wind and solar are unreliable and they need extra grid infrastructure to support it. You have to do that explaining. But I think to answer your question, we will still need coal. There is a justice and kind of an equity portion to the climate transition that you cannot ignore. But I think it's important, again, going back to our regulatory conversation, is that when you're investing in an ESG fund, you know what the manager's position is on those issues so that you can align it with your own
I don't think there's, for what Don said, there's definitely institutional demand. And I think there's going to be a lot of political backlash from about 70 million Americans who are on fixed incomes, retirees, who are just going insane from $5 gasoline, and it's going to hit $7 soon. And in my perspective is there's going to be a huge political backlash as a result of it, because nobody's talking about that transitional cost. People who are on fixed incomes who have to buy new cars or are now paying $10, will be paying $10 a gallon gasoline in 6 months.
Yeah,
I mean, that's a good point, because like basically with the transition as well, with everyone saying, well, we have to invest only in ESG products, there's been not as much investment into the exploration, either from a mining materials point of view or from a oil and gas. And obviously people in the industry kind of know the dynamics that you can't just switch things on and off, and to ignite sort of a mining which you'll need for EV as well. These things take years and years to build and to get to full capacity. And so by turning off the spigot and not putting capex into mining efforts, basically it's contributed to the supply chain crisis, that there's not enough there's not enough materials in order to do what we want to do to get to the ESG kind of environment that we're aiming to do. So I think it was a bit short-sighted with this kind of this initial push, to only be investing in ESG projects, and instead of understanding that there is a transition to manage till we get.
I'm just looking for the cost of the transition, but I mean, a great example, of course, is lithium, which I understand is only a 15-year supply of it. Your typical, Tesla battery will last 10 years.
So there's
lithium recovery technologies not developing as well.
It's not very good though, right?
No.
What's the percent?
There's a really good point brought up there. If you look at that's a good point. If you think about I started this off with is that if you look at, I think the world's going to grow, the global context, the world's going to grow as it's projected to we're going to run out of just about everything. So criminalizing resource that we have available, whether it's fossil fuels, anything we have, it's an inefficient way of thinking in the long term, right? We're just supposed to be, these goals are supposed to be aligned long term. So to your point, the issue, and I'd be curious your thoughts as well, is the issue in, coal is not going away, right? It's like thermal coal is going to go away. So the actual metallurgical coal, which is used as a feed into the steel industry, for example, we're a long time from transitioning away from blast furnaces, right? So the focus needs to be holistic decarbonization, not negative screening. Because less people are investing in that, less people will care about the emissions. So the important thing, I think, to your point, is that if you look at something like clean coal, like if it's billed to an institution, it's really explained holistically from a technical perspective. So it's not just, it's a coal play, it's a black box, it's a resource utilization play that's going to extend the longevity and the quality of life, and it's zero carbon. Like that's how you package them, right? Because I think certain things right now, like, it's funny, the lithium situation is quite interesting because there's not if you look at like the oil, the amount of times over the long term, the oil and gas reserves estimated have oscillated wildly. And it's interesting that it's correlated very strangely to the amount of geologists focused on oil and gas. So, the estimated recoverable lithium reserve have expanded quite a bit in the last couple of years. There's varying figures as to what degree, but there's estimates in the range of 20-30% in the last couple of years, right? So the issue that you're having here is that this is a new industry, and the industry has been located somewhere like China, where we don't get data, right? So, as we transition into some of these areas where there's a material resource issue, we have to rebuild, not just, like we used to do this in the United States, right? And we have to rebuild not just the ecosystem, but also the human capital to go figure out how we're going to do this, right? So it's the resource utilization thing, I think, is crucial when talking about any material. The coal specifically, in the immediate term, the cost of the transition, it's going to be significant, and we do have to burn coal. But can you say, hey, look, like all these banks now that are financing coal, you 5-year plan to attach carbon capture to all your facilities, right? You need to go and find a carbon capture, a CO2 pipeline. You can get this off the facility into storage, into utilization. Like that could happen, right? But the issue is that
US coal is pretty clean though, right? There's a lot of carbon capture in the United States domestically produced coal already.
So there's not. So right now,
versus China.
No, there's pollutant capture more than carbon capture.
Got it.
So
Right.
capturing carbon from an industrial facility is not a new process. Storing it is a new. Storing something for 50 years underground in manufactured casings is a business, right? And I think the idea in looking at, like, this goes into a whole nother discussion, but you think about in the immediate term what can be done if the government comes into the plate in conjunction with the private sector, banks adjust from negative screening to, let's say, like impact opportunity, possibly some return there. So you attach carbon capture to this in 5 years, we're going to ratchet the interest rate up, right? Just for example, as some kind of floating covenant you could attach to it. But those are things that we have to do that, and there's already a subsidy regime in place to account for the carbon capture system.
Is there a measurement of lithium production and pollution as a result of it? I mean, there's a lot of water pollution. If you mine lithium in Bolivia or Ecuador, right, there's tremendous pollution from that locality.
And this creates this. We can get a whole can of worms on this. This is an interesting.
I'm just asking.
No. It's interesting as you look at like one thing that's not reported widely. If you look at BHP, for example, and some of their sustainability initiatives, they're actually using modular desalination to feed water into some of their mining systems. So because you look at lithium, right? You look at the extraction. You look at there's a couple different things, right? From like oil and gas, right? If you look at from upstream to downstream, mining to processing to refining to utilization, there's a serious issue on the extraction side that the resource deposits are located near water scarcity. So to solve for that, if you think about, for example, we want to play lithium with, long-term contracts, very simple business over the long term, right? Build those modular desalination facilities and sell that water 20-year contract to BHP. It's probably going to be investment grade in 20 years. So I think those are things that, that's a major issue there, but there's already steps being taken to address it.
So you're saying that we're going to put modular water into the high plains of the Andes Mountains?
This is as I mentioned, the BHP has a case study of this. Like we can build a water pipe and utilize anywhere, right? So like if you look at the terrain on some of these, like this is not the first time that someone's artificially manipulated the terrain of a natural ecosystem to extract resources, right? Like just look at you know, like the entire, and it's going back to the Trump era, right? You know, we almost had a pure play Arctic drilling program commence, right? So, you know, it's interesting, like this is not a new phenomenon. If there's a national security or a criticality problem with resources, we'll figure out a way. It's the tools are there. The issue is that if you put a value on the natural capital that stands in the way of that, right? That's where you get into a big problem that we're not solving for right now.
I think the game hasn't been figured out, right? Because there's the fair value of the lithium, and the people who produce it aren't getting paid the fair value, right? So, right, because they're producing lithium at the end of the gun. Right, Bolivia's government was overthrown because of lithium, right?
So there's another. So
is that accounted into your calculation?
So this goes back. So like, it's funny on the operating business side. You know, my family's business operated a lot of different countries and dealt with a lot of international geopolitics related risk. And so it's interesting, like dealing with like there's a number of strategies to deal with nationalization risk in a jurisdiction like that, just based on like the so
it's really not nationalization risk, right? It's paying the indigenous people the value of what they're producing, right? So for 200 years, 90% of the silver in the world was produced in Bolivia. There's a mountain that's 1,000 feet shorter today than it was when the Spaniards came, and the Bolivians got nothing for it, right? So I'm saying pay the market value.
Well, and this is
I'm just saying, if you're talking about social equity.
But I'm not discrediting that. I'm just saying if we have to have this resource, right? Like there's a real conversation there about
So we have, what does that mean? We have to have the resource.
like if we're saying we're going to meet these net zero targets, right? That backs into that has to come out of the ground, right? So
Bolivia has no choice. But Bolivia says no, we don't want to do it anymore.
well, you look at, and I'd be curious to
Yeah.
your thoughts on this. It's like that's an international cooperation issue that we're already seeing right now with Russia, right? So
And China.
well, with China as well. It's interesting. The China situation, the lack of international cooperation. You look at COP, for example, and people opting out of coal retirement targets. You know, I mean, just that in and of itself, this issue of geopolitics underpinning the slowing of this transition is in the first inning, and we're getting a taste of it right now with Russia. And this could get considerably worse in some of these the resource curse that hits a lot of these jurisdictions in South America and in Africa. That's another. You know who the stakeholders in that is China. They've invested in a lot of these jurisdictions through the Belt and Road Initiative. And these are
Africa is owned by China. Right? It is, yeah. Mineral.
And Biden just announced a $600 billion initiative to kind of combat Belt and Road. And it seems like with speaking about an ESG solution, the solution needs to take care of the social needs of the Bolivian miners, right? And deal with that if it can be done.
Yeah, and I mean,
Is that
in terms of like there is to think of ESG as a Panica solution, that there won't be any trade-offs, and ESG is just naive. And I think that's the conversation that you have to have with your families, with your investors, is you have to talk about trade-offs. There's no situation in which there won't be trade-offs. But I think in terms of managing, you know, it in your portfolio, it's making sure that we have good data about companies, about the commitments that they've made, how they're going to track against those commitments for fair wage, for workforce policies, how they deal with employee health and safety, have all of that information to make out of, you know, XYZ number of metals and mining companies, the best possible selection. So lean into the theme, but lean into the best possible players in that theme.
There's an old saying that sometimes our solutions are worse than our problems. And you guys have all said this, it's transition. And I think transitioning properly is the key. We know where we want to go.
Correct. Yeah. And I mean, from a purely economic standpoint, though, I hope this discussion has shown you that there is investment opportunity and there is money to be made, because these problems are complex and there's a lot of governmental, consumer, and investor intention.
Martin, we should do this again next month.
We have one more question, and we will do it again in September. One more question.
September.
Thank you. So if you're an investor or you own a building in Midtown Manhattan, right? What's the best way to measure ESG? And is there a uniform certification, like LEED certification, for example?
Yeah, so from a real estate perspective, can follow up with more information, but again, it's basically whatever the most broadly accepted standard is, which would be LEED certification. I think, it's also all relative. So you need to make sure that whatever you're benchmarking against is done from a regional perspective. There's a lot of work, for example, in the real estate space that we work with a third-party provider for our clients that does kind of specialized real estate development and new home builds and stuff. All of their metrics are based off of your UK measurement. So making sure that you have a regional perspective to show whether or not you're good or bad, I think is really important.
So essentially measuring the E side of the equation, right?
Correct. Yeah, I think that's also where you're going to get the most quantitative data, and that's going to be most widely accepted by investors. From a social perspective in the real estate, I think it's very much, fair wage, fair employee practices, making sure that your recruiting practices for any building maintenance and staff is aligned. But those social issues will probably become increasingly important if there's also kind of government interaction. So whether or not the new mayoral team puts anything in place, that's all you're gonna have to kind of comply with.
One last little question. Company can be really good at S&G, but not E, so they're outside. Do you ever see that being separated, like, because environmental versus social government seems like really different topics, really different issues, and they're kind of lumping everything together. So do you ever see them splitting those up?
Yeah, so actually that's another huge trend in the market is to focus more on the S of ESG, and we're seeing a lot more funds focus on ed tech, fintech, kind of affordable housing and community services now. The reason why E is kind of led is because there's a lot less data in terms of what the gender and racial composition is of investable companies, public or private. So now that the data is getting better and people are committing to those metrics, we're going to see a lot bigger boom in terms of funds focused on that.
They're all kind of related, because if you think about, like, let's say like a waste to energy plant, one is an energy efficient source, but also there's a social impact to it in terms of improving the lives of the people who live in that environment by cleaning up all the landfills and the air pollution. So it's very much entwined, all the two. So it's all connected, but I guess some people want more metrics in terms of like the E, in terms of the impact on carbon and addressing that. But I think a lot of it is very much holistic and should be viewed that way.
What a great job, guys. Thank you so much. That's very interesting. It goes 30 minutes over schedule. So
Thank you, Marty.